Welcome, everyone, to Scheller Lunchtime Live, a live stream series hosted by the Georgia Tech Scheller College of Business. My name is Lindsay Kane, and I'm the Associate Director of Client Relationships for non-degree executive education programs. On select Fridays at 12 p.m. Eastern, you'll have the chance to hear from Scheller faculty, student, and alumni speakers as they discuss relevant topics from the tech-driven digital age. At Scheller, we're proud to offer undergraduate, MBA, and PhD programs, along with open enrollment and custom executive education programs. It's my pleasure to introduce Jacqueline Garner, Senior Lecturer of Finance at Scheller. She has published in numerous academic journals, including the Journal of Finance, the Journal of Business, Journal of Corporate Finance, Journal of Banking and Finance, and Financial Management. Her research focuses on corporate finance. More specifically, she studies issues related to initial public offerings, corporate governance, and investment bank compensation. Prior to academia, Jacqueline held various financial analyst positions and worked as a financial economist at the U.S. Securities and Exchange Commission. Today, Jacqueline looks at how top executives in the boardroom and on the football field are compensated and asks, is this too much or just enough? As always, feel free to ask questions in the comments section. Jacqueline will address as many questions as possible at the end of our presentation. Over to you, Jacqueline.
Thank you very much. And thank you for coming and attending. So as Lindsay said, we're going to talk about pay. And this topic is related to a research paper that I have, NCAA Football Coaches Pay and Performance. And it's joint work with Philip Humphrey and Betty Simpkins. And Betty is at Oklahoma State University. Philip is in industry. And so we have some interesting study here, and it's related to CEO compensation. So there's been a lot of research on CEO compensation, and we're borrowing the idea from that literature. So let's talk a little bit about CEO pay. So CEO pay it generates a lot of public ire. So we're going to talk about some facts about CEO pay. A couple of things. So Institutional Shareholder Services, ISS, finds that the average pay for a CEO in the S&P 500 grew from $11.5 million in 2013 to $13.6 million in 2017. A couple other facts. In 2017, the average CEO of the 350 largest firms in the U.S. received $18.9 million in compensation, almost an 18% increase over 2016. And that is from the Economic Policy Institute, also known as the EPI. So now, did you get an 18% raise that year? And then finally, according to EPI, in 2019, the ratio of CEO to typical worker pay was 320 to 1. In other words, the CEO on average made 320 times what the typical worker made. So this actually does generate some anger and just perhaps some misunderstanding. And so while that public ire might be warranted, the research on CEO pay is really not focused as much on the level of pay as it is on the relation of the pay to performance. And the classic pay on research, the classic research on CEO pay is related to something called pay for performance. And the paper, it's a paper that was from many years ago by Jensen and Murphy from 1990, and they asked the question, does increasing the coupling between CEO pay and performance result in higher firm performance? So while that paper is somewhat old, it serves as the basis for a lot of the research that is being done now. And so what they found was for a $1,000 change in shareholder wealth, CEO pay changed by $3.25. And they found that differed for large versus small firms. It was actually even smaller for large firms. It was $1.85 for large firms, and for smaller firms, it was $8.05. So their conclusion was the empirical relation between pay and performance is positive and significant, but it's small, and it's smaller than you would expect given how much people say incentive pay is important. So that's the idea of pay for performance. There's another idea, and it's called excess compensation. And so this table, the data from this table came from the survey from As You Sow, and they do a survey every year of the most overpaid CEOs. So overpaid is not the level of your pay, it's how much you were paid in excess of others that performed similarly as you, perhaps in the same industry as you, and so forth. They focus primarily, As You Sow, on prior performance. So these are the 3 top excessively paid CEOs in their most recent study. So if you notice, the CEO of Alphabet makes $281 million. $267 million of that is unexplained by past performance. So when you do this analysis, you're trying to see how much is it related to past performance, and very little of that pay is related to past performance. And the next 2 also have a lot of excess pay. So the question is, if you pay someone excessively, is that good? If you pay someone a lot, is it talent? Are they able to perform for you in the future? And what they found from this survey is no. In fact, these companies underperformed 1 year after their analysis. So that's the idea of pay for performance and excess compensation in the CEO literature. And the results are not so great. So we want to look to NCAA football coaches' pay. And we need to look at some facts, just like we did with the CEOs. So that's what we're about to do now. And those facts are the following. How are coaches paid? Well, they're paid very differently than CEOs. They have a base pay and typically a signing bonus. And then they have other guaranteed pay. They do have performance pay, but the performance pay for a coach is very different, obviously, from a CEO. You can't base it on stock returns or return on assets or return on invested capital. You base it on things like how many wins were there? Did you go to a bowl? Did you win the bowl? Academic achievement of the players, that sort of thing. So in our sample, and I'll get to the data of our sample, but the average annual pay in our sample is just under $2 million for the average coach. Now that's an annual pay figure. And if you include the performance pay, on average, their maximum pay is about $2.5 million. And what we find is the percent of guaranteed pay for a coach is almost 75% of the total pay. In other words, there's very little performance pay. Most of it is guaranteed pay. And that's really important to the premise of our work. And that also contrasts to the typical CEO pay. In fact, EPI, Economic Policy Institute, says that the average cash salary of a CEO only represents about 7% of total pay, because so much of their pay is incentive-based or bonus pay. So what's the premise of our research? When a coach gets paid, a coach signs a contract, and that coach in football signs a multi-year contract. So the 5 years, let's say it's a 5-year contract, the pay of that contract is outlined at the time of the signing. In other words, the guaranteed pay is outlined. And the pay is determined at this time the contract is signed. So what is it based on? It can't be based on future performance. It's actually based on prior performance. And they have, like I mentioned, very little performance pay. So our argument is, the premise is, their pay is more a function of labor market incentives, which is what most of us are used to. You do well, you perform well in a job at company A, you may get a promotion at company A and get a higher pay. Or you get a job at another firm for higher pay, but because you did well at a previous company. It's the same idea here for coaches. So when a coach is overpaid, he or she is overpaid because of prior performance, because that's the only thing that determined your pay at the time that you signed the contract. So let's talk about a little bit of terminology. So we briefly mentioned pay for performance and excess compensation. How would you test for that? So these are simple regressions, and pay for performance is typically run as follows. You run a regression, you look at the change in pay as your dependent variable, and you regress that on independent variable, something like change in shareholder wealth for a CEO, some sort of change in performance. And it's testing the sensitivity of pay and performance, or pay and shareholder wealth. Contrast that with when we do excess compensation, we're running a regression, again, of pay, but not the change in pay, just pay on specifically past performance. So did your past performance result in higher pay? And what we can do with a regression like this is take the residual. And the residual is basically the unexplained part of pay, what we can't explain by the pay. And some of those residuals will be positive, and some of those residuals will be negative. So if it's positive, somebody is overpaid. If it's negative, they're underpaid, because it's more than what would be expected by the past performance. And we can also include other control variables, such as for a CEO, industry, size of the firm. For a coach, you could include size of the endowment, things like that. But the main variable of interest is that past performance. Okay, so let's talk about, again, CEO pay versus coach's pay. So the problem with the literature on the CEO compensation is the pay packages themselves when you're starting to test things. The pay itself has so many performance incentives in it. Whereas for a coach, as we mentioned, the pay for a multi-year contract is determined at time T, and it was based on prior performance. But so with the CEO, you've got to ask yourself the question, are they responding to labor market incentives, or are they simply responding to the bonus or the performance incentives? We don't have that problem as much with coaches' pay. So let's look at what we did. We got a bunch of data in this paper. So we did an open record search. An open record search is by law, public institutions, if we request certain data, they are required to give it to us. So a lot of the universities are public universities, and so we were able to get the contracts themselves of the coaches. So we got a lot of contracts, and if it was a non-public university, it was a private university, most of them gave them, but they didn't have to. So we got contracts from 2000 to 2019, and we got all of the pay data as well as other data from those contracts. Then we got other data, such as what were your prior wins? What if you were at a different university previously, what were your prior wins? If you were at the same university and you are just getting a new contract, what were your prior wins? And then we look at future wins. So we get wins before and after you signed the contract. We also get data such as the Rivals ranking. Rivals is a service that ranks recruits going to play football. And so a lot of times higher ranked players are thought to be able to allow that team to perform better, because the ranking is generally based on the skill of that player. Then we also look at the strength of schedule. Were you able to win because you had an easy schedule, or were you able to win because you had a hard schedule? And then we control for the conference, ACC, SEC, etc. Okay, so what we want to do is, or the first thing we want to do is your prior performance of a coach related to higher pay? So just like we talked about with the CEOs, we run a simple regression of pay on past performance. And we get the residual from that, which is technically actual pay minus predicted pay. If it's positive, that coach is overpaid. If it's negative, the coach is underpaid. And what we really want to know, and what everybody wants to know, if you're overpaid as a coach, are you able to win? So our second test involves, are overpaid coaches better performers? So the first thing we do is we split the sample into the overpaid versus the underpaid coaches. And we examine the following year win percentage. And what I mean by the following year, the year following the time you signed the contract. So if you signed the contract in January of 2016, it's the 2016 season. So it's the season, the first season you were the new coach. And what we find is that overpaid coaches do have a slightly higher win percentage than the underpaid, 57% versus 49%. But you might think, well, that's not a lot of a difference. So then we split the sample into quartiles. And we looked at the lowest quartile, the most underpaid coaches, and the highest quartile, the most overpaid coaches. And now you can see a bigger difference. The highest quartile, the most overpaid, the 1 year after they sign the contract, they win 62% of the games. And the average of the next 2 years, the first year and the second year after they sign the contract, about 65% of their games. Whereas the underpaid, it's not terrible, but only about 50% of the games. We also look at the rivals' rank. Now, the lower the rank, the better. So if you're ranked number 1, you're the best. And the highest paid, the most overpaid actually have higher recruiting class rankings, not surprisingly. Okay, so what else do we do? Well, this might be interesting. We looked at the overpaid versus win by conference. Now, these are not all of the conferences, and I've just highlighted a few here. So let's look at what I've highlighted in green, the ACC. So the ACC, in our sample, 54% of the coaches were overpaid. And they won in the year following the contract signing, which could be different for different coaches. So we're looking at dates of signing and the next year's percentage. They win about 50% of their games. Well, look at the Pac-12. They win about the same percentage of games, but they have 90% of their coaches are overpaid. Look at the SEC. The SEC, 76% of their coaches are overpaid, but they win 66% of their games in the year subsequent to the signing of the contract. So that's just kind of some fun information to look at. We also look at some other things, and you might find this interesting. And this goes to the heart of what we're looking at, okay? So let's look at the most overpaid coaches. So in our sample, 3 showed up, and we could rank them. And again, this is based on a new contract. Okay, so some of these people have multiple contracts at a university, but we're just looking at that. And so Todd Graham at Arizona State, his average pay on the contract that was deemed to be overpaid was about $3.35 million. Okay, and you may go, but wait a minute, Nick Saban makes more. Why isn't Nick Saban ranked higher? Because remember, excess pay isn't level of pay. It's you were paid too much relative to your prior performance. So relative to Graham's prior performance, of that $3.35 million, too much of that was not explained by past performance. So 46% next year, not too good. So overpaid, next year you only won 46% of your games. Let's look at Nick Saban. Everybody always brings up Nick Saban. So Nick Saban, this particular contract, his average annual pay was about $9.5 million, but look at his winning percentage. And, it's just a fact that Saban keeps on winning. He does. Now let's go back to Todd Graham. What happened to Todd Graham? What happened to him? Well, actually, Arizona State fired Todd Graham because he continued to not do too well. And it took 2 years for Todd to get another head coaching position. And he's now the head coach at Hawaii, but it did look like labor market incentives worked somewhat. He was overpaid, didn't perform, lost his job, took a little while to get a new job. Okay, now let's look at the most underpaid. So in our sample, the most underpaid coach was Scott Satterfield. Now this was a few years ago, but his average pay was $375,000. But subsequent to signing that contract, his winning percentages were 58%, 85%, 77%, 70%, 85%. So what happened to Scott? How did this work out for Scott? Well, he got an extension after that contract, and the next extension got him about $448,000. He kept getting more extensions. And his last extension with Appalachian State, he was paid about $800,000. Where is he now? He's now at Louisville making $3.2 million. So even though he was underpaid at Appalachian State, he performed, and that $3.2 million is likely a result of, again, his past performance. So we are doing a lot more tests in our paper. So I'm really looking forward to hearing from some of your questions. But what have we done in this paper? We've looked at football coaches' pay. And what we find is their pay at the time they sign their contract can only be based on one thing: their past performance. And that performance could be a variety of things, but at a minimum, it's how many games they won at their prior school. We also find that overpaid coaches perform better in the future. And we think this is a really good example of labor market incentives. And the final thing that I want to mention to you, and I'm happy to take your questions, is we have some exec ed programs at Scheller. And these are the classes that we offer, and many more. You can go to this link to sign up. But one of the classes I'll be teaching this summer is financial modeling in Excel. And we'd love to have you in that class if you're interested. We'll be going over some advanced Excel functions. And we're going to be using all of those advanced Excel functions to build financial models to value a firm. So we'll be doing things like forecasting the three statements of a firm: balance sheet, income statement, and cash flow statement, feeding that into a discounted cash flow DCF model with the hope of and the goal of figuring out what the price of the firm is. And is that firm overvalued or undervalued? So I just wanted to mention that to you, and thank you for your attention, and I'd love to hear your questions.
Thanks so much, Jacqueline. This is so interesting to me. So what happened culturally and economically in the US that allowed CEOs and coaches to get paid such a large amount relative to others within their organization?
Yeah, so some of that is a result of a free market economy, which there's good to that and there's bad to that. You know, some countries historically have put caps on CEO pay, and generally speaking, we have not. And so when the literature first started with CEO pay, what happened was, how do you incentivize a CEO? How do you incentivize? So a CEO, unlike a head coach, a CEO is an agent for the firm. They're acting as an agent for the other shareholders. Now, they may own some shares themselves, but they are supposed to act in the best interest of the shareholders. So the idea was, well, if I incentivize them with little pay that's guaranteed, I'm going to give them a low salary in terms of cash, and I'm going to make the incentive pay huge, and that incentive pay is only valuable if the stock price, for example, goes up. That was the idea. So the problem is that becomes, in some sense, a self-fulfilling, right? So if the firm does really, really well and the stock price goes up, right, then the CEO is going to be paid more. The problem is, what the results are suggesting is that good performance doesn't always continue. But so now we have in corporate governance, we have something called shareholder pay, vote on pay. So shareholders can vote on whether or not they approve a CEO's salary. The problem is, at many companies, that vote is what's considered in corporate governance non-binding. And so even though if more than 50% are unhappy with CEO pay, the board can ignore that vote. And so if they ignore that vote, even though the shareholders are unhappy, the excess pay will continue. And so the only way a shareholder can then show their displeasure is to what is called in the corporate governance literature, vote with your feet. And voting with your feet means you sell your shares, which is may not what you want to do. So that's what happened on that side. I think with coaches, there's probably a lot of factors that has happened, but some of that is the explosion of networks like the SEC network, Texas Longhorn Network, ACC network, which has brought in a lot of revenues to college football, college athletics, not just football, but particularly football. And a lot of the contracts, I don't want to go through too much detail of this, but a lot of the football contracts, what if it's a public university, what the state is on the line for is a minuscule part of that guaranteed pay. A lot of the other is coming through another section of the contract, which allows for the coach to be paid for marketing efforts, and that has exploded in recent years.
That's really interesting. I was going to ask what, if anyone is watching this or they're reading your research or anything like that, are they going to make changes? But it sounds like they may or may not.
Well, I think the thing that's right now, and this is not what our research is about, but because of the explosion in CEO pay, obviously that's on the corporate side, things are being said about that. There have been talks about, should we cap the pay? That was years ago. Should we cap the pay? The thing now, and this is not what our paper is about, but in the past probably 10 years, a lot of things that have been happening, there have been lawsuits against the NCAA about whether or not the amateurism level of a collegiate player. And there have been different lawsuits about that. So right now, the thing that is all over the news is this name and likeness idea. And can a player that's an amateur make money on his image or her image? Could they do something marketing wise and make money off of that? And a lot of states are allowing for that. People are waiting for the NCAA to make a ruling or to have a ruling at the federal level. So that's coming. We saw some things in the NCAA tournament about this, about if you're going to pay the coaches, should we pay the players? And I don't want to take a position on that because that's not where my research is, but that is what is being discussed now, is whether or not players should be paid to some extent, maybe not in terms of a salary, but in these other ways, right? And little by little, that is being allowed. There is already some allowance for that. And will there be more allowances for that is the question. And then proponents obviously want that to happen. People that are opposed to it are afraid it's going to change collegiate sports and it won't be the same. So there's a lot of debate on that right now, not so much on coaches' pay, but more on, there is about pay and performance, but not so much about caps on pay. Yes.
And are coaches in control over the budget to hire their staff, or is it, do they kind of follow the same guidelines?
Yeah, they will negotiate that.
Okay.
And most of them, a lot of them, when they move to another university, let's say they were very successful at one university, often they want to bring their staff with them, particularly in the following way. They may bring both the offensive and defensive coordinators. But a lot of times what you'll see, if the head coach is a defensively minded coach, they may always bring their defensive coordinator with them and maybe not the offensive coordinator. When Dan Mullen left Mississippi State and he went to Florida, he took a lot of his staff with him, a lot. In fact, another interesting tidbit about Florida, there was talk about labor market incentives. The quarterback coach at Mississippi State when Dan Mullen first went to Mississippi State. Subsequently went to Houston as an offensive coordinator. Left Mississippi State because that was a move up. He went to be an offensive coordinator at Houston. Dan then went to Florida. Well, they have such a good relationship, this person and Dan Mullen, because this person, his name is Brian Johnson, had played for Dan Mullen. So when Dan Mullen went to Florida, he followed him to Florida because Florida would have been a step up in terms of pay and that sort of thing, right? And so he was the quarterback coach and co-offensive coordinator at Florida. He then was named full offensive coordinator, and he's now, just this past season, he's now the quarterback for the Philadelphia Eagles.
Wow. Well, so one more quick question.
Yeah. And so people are likely to take people with them. Yeah.
Well, we are almost out of time, but I do want to ask one last quick question.
Sure.
Would a salary cap be a disincentive to winning, particularly for winning coaches?
Yeah, so it's interesting. I think that's a really interesting question. So based on the fact that so much of their pay is guaranteed, it may be. It probably isn't as much a disincentive for somebody like a Nick Saban because he's won so much. I mean, granted, the problem is it might not be a disincentive. I don't think somebody like Nick Saban is performing because necessarily of his salary. And I don't know Nick Saban, so I'm not speaking for him, but I'm just saying in general, do people want the higher salary only to be a measure of their worth? It's not that incentivizes them or not, but it's like, well, I'm making the most, so I'm the best. And again, I don't know if Nick Saban thinks that, but I'm just saying, is that part of the problem? It just becomes a ranking, and then I'm paid the most, so I'm therefore the best. And therefore, the other thing that we do see is buyout. All the contracts have a buyout clause. And I just looked at Nick Saban's most recent buyout clause. It's really, really low. It's really low. It's probably because there's no real risk of him getting fired. So it's really low. The other thing that's interesting, Herm Edwards, he had been a coach, he had been a player, and then he was a coach in the NFL. He was on ESPN for years, and he went and took a head coaching job. And he had a lot of his pay in performance pay. Because my guess is, even though he had been known for years, he clearly knew the game. He hadn't been in coaching for a while. So the contract composition for him was very different than it is for the average coach.
This was so interesting. Thank you so much, Jacqueline. There are some other really great questions on LinkedIn, so hopefully you can get to those in a little while. But thank you to everyone for joining us this year for Scheller Lunchtime Live. We're taking the summer off, but we'll return in August with new topics and speakers. You can keep up to date with future Scheller Lunchtime Live sessions, executive education opportunities, and other events by following the Georgia Tech Scheller College of Business on LinkedIn. A recording of today's session and future sessions will be available on our LinkedIn and YouTube pages as well. We'll see you in the fall. Thank you.
Thank you.